So the topic that we are starting up with called inventories, one of the lighter and easier topics at CFA Level 1. The first LOS is cost that are included or excluded as a part of inventory. So now let's do an example that we have earlier seen in income statement as well. Let us say you're a manufacturing firm. You started your operation in 2020. This year you made purchase of raw material of 10,000, but you did not make any sales. So when you post your expenses in the income statement in 2020, your expenses would be 0. Okay, because what will appear on your balance sheet, in your balance sheet there would be a section called inventory. Within inventory there are generally 3 subparts: raw material, work in progress and finished goods. So in 2020 we will have raw material of 10,000. 2021 you started processing this raw material, and on labor you spent, let us say, 5,000, plus you paid rent of 5,000, or let me say rent of 7,000. Again, the amount of sales that you've made is 0. Now your expense in 2021 will be 7,000. Now what you would say is that this rent is a period cost, and period costs are not added to the cost of inventory. They are expensed in the period in which we have incurred them. Okay, so costs like rent you would not add to the value of inventory, but labor, since this is a direct conversion cost, you will add that to the cost of inventory. So on your balance sheet, under the inventory section, this year you will show raw material as 0, but you will show work in progress as 10,000 of last year plus 5,000 of labor this year. So work in progress would be 15,000. Then 2022, let's say you spent packaging cost of another 10,000. Again sales 0. Since your sales is 0, this year again your expense would be 0, but now your inventory would be of 25,000. This inventory now would be your finished goods. So this packaging cost, which is again a direct conversion cost, you have added to the cost of your inventory. Are you following this? So the all manufacturing cost, which is not a period cost, which means it is not a monthly or annual rental type of expenses, we will keep on loading up that to the cost of inventory. Does that make sense? So please write this down quickly. So generally, imagine that let's say you're looking at maybe a handicraft type of setup. So if the labor does not work, then the value of inventory will never increase. So the way raw material is a part of inventory, even when labor work, they increase the value of their inventory. So when your inventory progress from raw material to work in progress, in this example it was only because of labor. Are you following this? So all those costs which are directly used, which is enhancing the value of inventory, we will keep on adding that to the cost of inventory. If there was a rent in 2022, then again 2022 rent would be an expenditure. Yes, irrespective what, rent is not to be added to the cost of inventory. That is the idea. Let's say in 2022 there was also a storage cost. Okay, let's say storage cost of 5,000. Should we add to the cost of inventory? No, because again storage cost is typically considered as a period cost. So again, if there was a storage cost, then this also we would expense, and then we will show as expenditure as 5,000. Following this? But think of certain industries where storing inventory enhances the value. For example, basmati rice. The longer you store, higher would be the value, or maybe liquor. So the more you store, the value will enhance. So in those kind of industries where storage actually enhances the value, storage cost is also added to the cost of inventory. But generally, for most of the other industries, storage cost is period cost. It is expensed when incurred. Are you fine with this? Now see what happens in the next year. So this is year 2023. Now in this year, let's say half of your inventory is sold at a price of 50,000. Now this year you would post an expenditure and you would say that since we have sold half of the inventory, what was the valuation of inventory on balance sheet last year? 25. So this year your expenditure would be 12,500 and this expenditure is called as COGS, cost of goods sold. And then again you will have a closing inventory. Again that closing inventory is finished good and that amount would be whatever is left unsold, which is 12,500. Make sense? Please write this down. Here so let's say maybe you were a shoe manufacturing company. So by the end of 2022, you had 100 units of shoes with you. So if you sold 50 of them, then you would say half of this is expenditure, remaining half is still lying with us. But if you sold more, so you would make proportionate calculations. Yes, in this case, we have assumed that. Now next heading in the notes, which is a part of the same LOS, normal versus abnormal loss. Normal versus abnormal loss. So I experienced this concept firsthand few years ago when I was working as a consultant to a really large chocolate manufacturing company. So this company had one plant in Pune and one plant in Mumbai. And the manufacturing process, if they put in 100 kg of raw material into their processing unit, so melting and whatever processes that chocolate used to go through, typically the output that they used to get was 80 kgs of finished goods. And again, the idea of this was that there was a loss in the form of evaporation or there was a lot of other process related losses. So let us say that valuation of this 800 kg, the value of that raw material was 800. Since that 20 kg loss was a normal process, they used to completely ignore accounting for it and even the finished goods were shown at a valuation of 800. So this 20 kg is typically considered as a normal loss and it is simply ignored in the books of account, which means ignored in the books. There is no recording for these kind of losses. Why? Because you accept the fact that when you put in about 100 kgs, you would typically get output as 80 kgs. That's your manufacturing process loss. But one particular batch, when they started production, they started with 100 kgs. But imagine there was an electricity loss. I'm just making it up, hypothetical scenario, that during manufacturing batch, there was electricity loss and the output turned out to be only 70 kgs. Now this time what they will say is that 20 kg is still a normal loss. We don't want to recognize that in the books. However, those additional 10 kgs would be considered as a abnormal loss. Okay, this is not something that happens every batch. Maybe it happens once in a while. And this 770 kgs worth of inventory, you will show only at a price of 700, not at 800. And you would book loss in your income statement of 100. Does that make sense? So please write this down. And essentially what this is telling us is that abnormal loss is not included in inventory value. Are we done with this? Now next three LOS, they are in a way integrated with each other. So next heading in your notes would be inventory cost flow methods. Inventory cost flow methods. So let us say there is a trading company. They are in the business of buying and selling goods. So we are looking at their purchases. So this is quantity. This is price per unit. During the year, they have made 3 purchases of quantity 10, 10, 10. And price per unit for the first purchase was 5 per unit, then 10 per unit, and let us say 20 per unit. During the year, the total amount of sales that they have made, let us say, is of 10 units at the rate of 20 per unit. So total sales of 200. They want to determine what should be their COGS, cost of goods sold. And we have learned this part earlier in income statement, that one way of doing it is they can use LIFO method. And in LIFO, the assumption would be last in, first out. So the last purchase inventory is at what price? 20 per unit. So 10 into 20, COGS would be how much? 200. And because COGS is 200, what is the gross profit? Gross profit would be 0. And what is the closing inventory? Closing inventory would be made of these two items, which is 50 plus 100, it would be 150. Have you followed this? Closing inventory is the first to purchase, 10 into 5, 50, 10 into 10, 100, 150. But what if instead of LIFO, they decided to use, let us say, FIFO, first in, first out, then COGS would be 50. That would get us a gross profit of 150. And closing inventory would be the last two items left. So closing inventory here, this would be 200 plus 100. Closing inventory would be 300. The third method that can be used is weighted average. So in weighted average, first we will have to calculate what is the average cost. So this is 50, this is 100, this is 200. The total amount we've spent is 350 and total quantity we've received is 30. So your average weighted average cost per unit would be 350 divided by 30, which is how much? 11.67. So your COGS here would be calculated as 10 into 11.67, which is 116.7. And then that would get us a gross profit of 83.3, and that would get us a closing inventory of 350 minus 116.7. How much? Please cross check the calculations. 233.3. Is that fine? And of course, there is also an alternate method available called specific identification, which is typically put to use when your inventory is of unique characteristic. That means every item is unique. So the best example, best industry where you can put this to use is maybe vintage cars, where every item is unique. So you can specifically identify which item you've sold and at what cost it was acquired. Are you fine with this? So please write this down. How is the gross profit calculated? How much is your sales? And how much is COGS? 116. 200 minus 116.7. I'll show you how it works in real life. Another thing that now you would write down is, done writing this part, that LIFO is allowed only in US GAAP. LIFO is allowed only in US GAAP. You would not, which means IFRS does not allow LIFO, but other methods are permissible. And because in US LIFO is allowed, there is also a special mechanism called LIFO reserve that I'll come to towards the end of the session. Done writing this part? Now what happens because of this? Observe carefully. Would you agree with me that it appears like an inflationary environment? Because first price was 5, then 10, and then 20. The prices are increasing during the year. Now in an inflationary environment, LIFO COGS will always be highest. Does that make sense? Because your last in first out, your COGS is always made of more expensive items. FIFO COGS would be lowest, and weighted average would always be between these two. But because LIFO COGS is highest, LIFO closing inventory would be lowest. Observe this. Closing inventory here was 150, but FIFO closing inventory would be highest, and then weighted average would always be between these two. And if you'd see now, there is a tremendous difference in gross profit, isn't it? In one case it's 0, whereas in other cases 150, same business. And therefore it is very, very important. Therefore it is very, very important that when you're comparing a LIFO firm with VIFO firm, you understand and have all these things at the back of your mind. Okay, so let's make a comparative schedule of what impact it can cause on ratios. impact on LIFO firm. In bracket we would write down as against FIFO. Okay, so maybe you can write once I finish this. Just understand now. First item, let us say COGS. Can I say that now, assuming an inflationary scenario, of course, in an inflationary scenario, can I say that LIFO firm will always have a lower COGS in an inflationary environment? Yes or no? A LIFO firm will always have a lower COGS? No? A LIFO firm will always have a higher COGS. Last in, first out. If it is an inflationary environment, we are using more expensive inventory towards the sell, so it would be always highest COGS. And because your COGS is higher, can I say that closing inventory would be higher? No, closing inventory would be lower. So COGS higher, closing inventory lower. Now, can I say that gross profit, tell me, gross profit lower or higher? Gross profit would be lower. Because your COGS is higher, automatically your gross profit would be lower. What will happen to the cash flow? Cash flow would be higher or lower? How many of you feel higher? Higher. How many of you feel lower? Okay. So cash flow would be same. It will not have any impact on cash flow, ignoring tax impact, which is generally the case at level 1. I don't think there would be questions asked on cash flow considering taxes in this section. So, see, it's like this. You sold 10 units. You sold them at a price of 20. You received cash of 200. Now, it is your accountant who is going to decide what method he wants to use. LIFO, FIFO, weighted average. And that is simply an accounting entry. It's not changing anything in real world. So, irrespective of which inventory valuation method you use, as long as you are not considering the tax impact on cash, the amount of cash flow is going to be same. Are we fine with this? But cash flow considering taxes, now tell me, in case of LIFO, would that be higher or lower? In case of LIFO, will that be higher or lower? It would be higher. Why? Because in LIFO, COGS was higher. COGS was higher, gross profit would be lower. Gross profit lower, profit before tax lower. Profit before tax lower, taxes paid lower. And because you're paying less taxes, automatically cash balance compared to a FIFO firm would be higher. Does that make sense? Then, how about total equity? Will that be higher or lower? Total equity would be higher. Sorry, my mistake. Total equity would be lower. Why? Because your COGS is higher. Therefore, profit is lesser. And lesser profit will add to your equity. So, automatically your equity is lesser. That's one way of thinking. The other way of thinking is, since your assets are going to be lesser, the compensating effect, even equity is going to be lesser. Make sense? Let us look at few important ratios. Inventory turnover ratio. What do you think? Higher or lower? Inventory turnover ratio, higher or lower? Inventory turnover ratio would be higher. This ratio is calculated as COGS divided by average inventory. COGS would be higher, average inventory would be lower, automatically ratio would be higher. Make sense? Current ratio. This is calculated as current assets divided by current liability. Since value of inventory would be lower, current assets would be lower, this ratio would be lower. Are we fine? So please write down. And the trick is not to remember. Because if you remember, then you would end up remembering at least 500 scenarios. This is just inventory. The trick is to understand what happens to the numerator, what happens to the denominator. You should be able to imagine all the flows of different numbers in the financial statements. Is there any part you want me to repeat again? Should I clear off this? Apart from cash flow, any other doubt? See now how cash flow works. Let us create hypothetical income statement for two firms. Let us say this is LIFO firm, this is FIFO firm. Sales, you don't have to write, this is only for understanding, 1000, 1000. COGS, 400, 200. So gross profit, 600 and 800. Do you agree that LIFO firm will always have a higher COGS? Yes, as long as there is a inflationary environment. Minus all other expenses. Okay, so let's say 300 and 300. So that would get us profit before tax, 300, 500. Let us say tax rate of 50%. So this would be 150, 250. And profit after tax, 150 and 250. Now let's look at them purely from a cash perspective. Let's look at this firm first. Sales, have they received cash of 1000? Yes, so that's cash entry of 1000. COGS 400, have they paid cash of 400 this year? No. Did you not see the first example that the cash was paid even in the earlier years, not necessarily this year's? Are you following me? So not necessary that COGS is the cash paid. Cash paid is the amount of purchase, not COGS. Are you following me? So both of these amount technically does not really have any impact on cash. Expenses 300, 300. So this is minus 300. This was also plus 1000, minus 300. Then tax paid, this would be minus 150, but this would be how much? Minus 250. And since you're reducing 100 extra, your cash balance would be lesser by 100. Correct? So therefore we say that a LIFO firm will have higher cash balance compared to FIFO firm purely because of differences in the amount of tax that they would pay. Is it fine? But if you do not consider the tax impact, then the amount of cash balance with both the firms is going to be same. Any questions? Please ask. Rahul? Because it is not a cash. COGS is not a cash expense. Purchase is the cash outflow. COGS is whatever inventory you have, you just sold it and your accountant made an entry. Is it making sense? Okay. Yeah, the question she's asked is, generally inventory turnover higher the better, but LIFO will automatically have higher inventory. So then as an analyst, you're supposed to know that maybe because the firm has a LIFO, therefore inventory turnover is higher. In the same fashion, maybe because the firm is FIFO, therefore gross profit is higher. Isn't it? So both of them have their own advantage and disadvantage. So analyst, when you look at the numbers, you also need to consider the fact that which firm, which method the company is using and what impact does that have on different ratios. Are you fine with this? Okay. Now, is there anyone in the class who considers himself, okay, no one would say yes. So let's say there is a lazy accountant with us here. So this is the first fellow. How do I draw a lazy person? Okay. Okay, so this is a lazy accountant. And we have one more accountant. Okay, this accountant, I call him as the Red Bull accountant. So who's always hyper excited and willing to work. Now what's happening is that there are entries passed by an organization. So the data is like this. So this is quantity and this is price. During the year, first purchase was made, quantity of let's say 100, price of 10 per unit. Then quantity of 300, price of let us say 20 per unit. Then quantity of 500, price of let us say 30 per unit. So this is in the sequence. So maybe let me give them dates. This is first. This is 10th. This is 17th. On 19th, a firm sold 500 units at a price of 60 per unit. On 25th, it purchased 1000 units at a price of let us say 40 per units. Now we have to find out that both the firms are using LIFO. Okay, so in fact the firm is using LIFO, but there are two different accountants and both of them are given an assignment that please calculate COGS using the LIFO method. Let's look at the second guy first, the accountant who's on Red Bull. So on 19th, he would see that there is a sales transaction made of 500 at the cost of 60. Since he's so active, immediately on the same day, he wants to pass an entry in the books to calculate COGS. He doesn't want to wait for the month or year to get over. So same day, he will say last in first out, which was the last purchase, 500 on 17th at the cost of 30. So this accountant will come up with a COGS amount of 500 into 30, which would be 15,000. Are we fine? This accountant who's lazy, he will wait for the entire financial year to get over. He would not worry about dates, but at the end of financial year, he will check with the sales team how many units you have sold. They will say 500. Then he will open up all the purchase bills and then he will say what was the last purchase made, and he will say last purchase was made on 25th. Are you following this? So 500 at the cost of 40, this accountant COGS would be 20,000. So again, both the accountants are using LIFO method, but again, both of them are coming up with different COGS numbers and both of them are correct. So the first type of accounting method, we call this as periodic system of inventory management, where at the end of the accounting period, you find out what were the sales, what were the purchases, and use last entries. Whereas this accounting system, we call this as perpetual system. The moment a transaction happens, immediately at the same time, you want to book your entries. Logically, the first accountant in a way is making mistake, because what he's essentially saying is that the goods which were sold on 19th were technically purchased on 25th. Are you following this? Which is not possible in real world, but this accounting method is still okay. So as a firm, you have a liberty to decide which method of accounting system you want to use, periodic or perpetual. Please write down. Then writing this, same point but different perspective of discussion. Okay, let's again do an example. Let us say your purchase and sales data is like this, quantity and price. Quantity 10. Let us say that firm uses FIFO inventory management system. Find out what would be COGS under periodic and under perpetual inventory management system. So we are using FIFO. Find out what would be COGS under periodic, what would be COGS under perpetual. Will it be same? So in periodic, you would say COGS here, first in, first out. So you're making entry at the end of the year, but even then the still first two purchases are here. So 100 plus 200, it would be 300. In perpetual, you're making entry on this date. These are still the same purchase, and again COGS would be 300, which means that if a firm is using FIFO, then periodic and perpetual inventory values will always be same, they will not be different. But if you're using LIFO, periodic and perpetual might come up with significantly different values from each other. This was the point Vishal was referring to a couple of days back when the success, Vishal, do you remember Vishal? He discussed about one question. So this point he was referring to, there was a question, and the only concept you needed to know that if you're using a FIFO system, whether it's periodic or perpetual, the values are same. Please write down. Done. Now the same question, but let us assume, can I clear off? Let us assume that it is a weighted average. Will the values be same now? No. Now the values would be different in periodic and the values would be different in perpetual. Okay, so now please understand this carefully. A lot of people struggle with this concept. You're using periodic system. It is weighted average. The accountant is lazy. He is going to pass the entries at the end of the year. So he will see what was the quantity sold, 30. what was the total quantity purchased in this year. So he will consider this purchase, this purchase, this purchase, this purchase and this purchase. Let's find out what was the total purchase. 100, 200, 360, 1200 and this would be 1600, 2800, 3100, 3460. Please cross check my calculations. Is this correct? So once we have, is the calculation correct? So once we have total valuation of inventory, then we will say at a price of 3460, how much we have, how much inventory we purchased? 50, 60, 100, 150. So on an average, what is the cost per unit? 3460 divided by 150. That would be 23.06. So this is the weighted average cost per unit. And therefore your periodic inventory valuation, it would be 30 into 23.06 COGS. How much would that be? 69. Okay, let's say 692. But if you're using perpetual inventory management system, then the accountant would want to pass inventory on this particular date. And therefore, the purchases that he would convert are all those purchases which were done before that date. So only the first three. And then he would say total purchase. This is 660 divided by 60, which is 11. And therefore, your COGS would be 30 into 11, 330. So which means if you're using LIFO, periodic and perpetual will come up with different numbers. If you're using weighted average, periodic and perpetual will have different number. But in FIFO, periodic and perpetual will have same numbers. Do you want me to explain this again? Of perpetual? Since the accountant is passing entry on this date, I'm repeating the perpetual part again. Accountant is passing entry on this date. To calculate weighted average, he will consider only these three purchases. Because today, assuming this is today, he doesn't even know at what price and what quantity would be purchased in future. So you take total of this purchase, which is 660, total quantity 60, so average price 11, 30 into 11, 330. Whereas in periodic, we considered all the purchases. That's the difference. Same LOS, but next point of discussion. Done writing this? Now next question is that which of this method show the economic truth or economic reality on the financial statements. Okay. So let's say you're looking at income statement of two firms. First firm has used LIFO, other firm has used FIFO. Now which income statement you would feel is more appropriate? It is showing the true economic picture. The firm using LIFO or the firm using FIFO? LIFO or FIFO? Or can't say? How many of you feel can't say? Okay, it's not an option. Choose between LIFO and FIFO. How many of you feel LIFO? How many of you feel FIFO? Okay. Now imagine this. Let us say your purchase schedule is like this. First quantity maybe was purchased at 10, then it was purchased at 15, maybe 17, maybe 20. If you're using LIFO, on the income statement we put COGS. And can I say that COGS will pick up the recent prices? Are you following this? So the true economic picture means showing what is the recent price. And when you use LIFO, COGS is at recent prices. And therefore, so here I'm writing it, COGS is at recent prices and therefore it shows true economic picture. Are you following this? Now in the same fashion, let us say that we are looking at balance sheet. Again, one firm is using LIFO, other firm is using FIFO. Which of these two firms you think will show now the true economic picture? LIFO or FIFO? Now the FIFO firm will show true economic picture because in FIFO, the first in, first out, the first purchases went into COGS. The most recent prices are shown in your balance sheet. Are you following this? So here we will say that balance sheet values or inventory value is at recent prices. Now, of course, I am not saying here that we can use LIFO on income statement and FIFO on balance sheet. That's not allowed. But what I'm trying to say is, if you're looking at a firm which is using LIFO, you will have higher sense of comfort with income statement, but you would be slightly skeptical about balance sheet inventory values. But if you're looking at a firm using FIFO, you would say that balance sheet values are more correct. They're showing the correct picture, but income statement values are maybe not showing the correct picture. Is it clear?